Welcome back to Economic Outlook. Today we're going to talk about a series of unprecedented events which have occurred over the past 10 days. First, we'll look at the government bailout of Fannie Mae, Freddie Mac, and AIG. Next, we'll look at the bankruptcy of Lehman Brothers, the acquisition of Merrill Lynch, and the possible failure of Washington Mutual. Taken together, these events show that the financial crisis, which began over a year ago, is still with us today. Along the way, we'll examine the causes of this crisis and try to figure out how close we are to reaching a resolution. We'll start our discussion by looking at the bailout of Fannie Mae and Freddie Mac. To understand why the federal government's bailout was so important, we need to understand the role Fannie and Freddie play in the domestic economy as well as in the international financial community. Freddie Mac and Fannie Mae both are mortgage lenders. However, they don't actually issue mortgages themselves. Instead, they buy mortgages issued by banks or mortgage brokers, and then package these mortgages together and sell them as securities to investors. Now, in theory, these mortgage-backed securities are safe because they're collateralized by the houses the mortgages represent. Since mortgage-backed securities were viewed as relatively safe, less risky investments, both Fannie Mae and Freddie Mac were able to keep small amounts of capital on hand relative to the securities that they sponsored. As home prices began to decline in 2006, this level of capitalization became too small. The collateral for the mortgage-backed securities issued by Fannie Mae and Freddie Mac became less valuable and more risky. Therefore, the companies needed more capital on hand to secure the securities that they issued and sold to investors. The increase in risk relative to the capitalization of Fannie Mae and Freddie Mac caused stock prices of both companies to fall. Additionally, it made investors less likely to purchase the mortgage-backed securities issued by the two companies. This caused Treasury Secretary Henry Paulson to request from Congress the authorization to spend money to prevent the failure of both companies. Ultimately, he pledged $100 billion to each company to back up the securities issued by Fannie Mae and Freddie Mac. The question is, why are Fannie Mae and Freddie Mac so important that they deserve a $100 billion backstop each from the federal government? And there are two main reasons for this. First, if Fannie Mae and Freddie Mac were to fail, the housing market in the United States would likely collapse. Since Fannie Mae and Freddie Mac purchase mortgages from banks and dealers and then sell them to other investors, they provide important liquidity in the marketplace. If either of the institutions were to fail, this liquidity wouldn't be there, and banks and mortgage brokers wouldn't be able to write as many new mortgages for customers. This would cause interest rates to increase sharply. With the backstop in place, banks and mortgage brokers can write mortgages and be assured that Fannie Mae and Freddie Mac will be able to purchase them and resell them to other investors. This liquidity is critical to our housing markets. Since the backstop was put in place, mortgage rates have dropped from 6.67% for a 30-year fixed rate down to around 5.6%. To keep the housing market from further spiraling downward, it's important that lending rates remain low and affordable for most consumers. The second reason for the importance of Fannie Mae and Freddie Mac is more complicated. Put together, both companies have issued over $5.3 trillion of securities to global investors. Now, one of the reasons Fannie Mae and Freddie Mac were so successful is that they were quasi-government bodies, even though they were technically public companies with publicly traded shares. Because of Fannie Mae and Freddie Mac's position with the federal government, foreign bodies who purchased securities from the two entities assumed that they were backed by the full faith and credit of the United States government, just like treasuries. Normal United States treasuries are backed by the full weight of our federal government. That means there's very little likelihood that they'll be defaulted upon. However, Fannie Mae and Freddie Mac were not explicitly sponsored by the government. They had an implicit understanding that the securities were backed by the United States Treasury. Since the securities issued by Fannie Mae and Freddie Mac offered higher interest rates than most treasuries, and had the implicit backing of the US government, they became very popular among nations with trade surpluses with us, like China or Japan. The failure of Fannie Mae or Freddie Mac could have jeopardized the status of all US debt outstanding in foreign nations, so it's more understandable why the Treasury Department would have used taxpayer funds to try to bail out Fannie Mae and Freddie Mac to prevent this from happening. It has benefits both domestically and for our international monetary policy. Next, we'll look at the bailout of AIG and see how it differs from that of Fannie Mae and Freddie Mac. AIG was nearing bankruptcy because of credit default swap exposure it faced and its inability to raise funds in the private lending market like other investment banks. The Federal Reserve stepped in with access to $85 billion in capital in exchange for an 11% annual interest rate and a 79% ownership stake in AIG. The Federal Reserve made this offer to AIG to give it adequate time to sell its assets in an organized manner. In a bankruptcy, AIG would have been forced to sell off many of its divisions at prices below their market value. With this line of credit, AIG will be able to sell off its healthy business units to suitable competitors at an adequate price. This will prevent undue disruption in the markets and will help decrease some of the turmoil we've seen as major financial institutions declare bankruptcy or endure major write-downs. Lehman Brothers' problems are similar to those of many other investment banks. When their bad debt obligations became more apparent, they were unable to find counterparties for their trading transactions. Without these counterparties, they were simply unable to conduct their business, and eventually they had to declare bankruptcy. I'm sure Lehman Brothers was hoping for a bailout package similar to what Bear Stearns received back in March. However, the Federal Reserve did not give Lehman Brothers this option, and sent a message that it was not afraid to let large investment banks fail if they had risky portfolios and improper institutional control to manage that risk. Another banking casualty this week was Merrill Lynch. Merrill was acquired by Bank of America in a $50 billion all-stock transaction. Merrill gives Bank of America the brokerage and wealth management business it needs to compete with Citigroup, another large universal bank. It also gives Bank of America the New York Wall Street presence that it sought for many years. It's unlikely that Merrill could have been acquired so cheaply had it not entered into similar bad transactions as other investment banks like Lehman Brothers. Another bank facing potential problems is Washington Mutual. Although not in imminent danger of declaring bankruptcy, Washington Mutual's bad debt obligations have left its debt rating low and its share price at a point where it can't raise capital effectively. Many feel that Washington Mutual will need to merge with another bank in order to stay solvent. If it doesn't, it will become the 12th bank insured by the FDIC to fail this year. As these banks and financial institutions continue to struggle, their problems will spread to other parts of the financial market. Today we saw a 400-point sell-off in the Dow Jones, which affected companies as diverse as GE, General Motors, Boeing, and several airline stocks. All of the remaining major investment banks fell by at least 10%. The unprecedented events of the past 10 days make it clear that the fallout from the liquidity and credit crisis that began last year is far from over. It remains to be seen exactly how the investment community will sort out the remaining bad debt obligations and how these obligations will continue to affect investment banks and other companies.